Welcome back, everyone. This is Dr. Moore of EfficientMinds.com, and we're on our third and final installment of the Personal Finance Overview presentation. In case you're wondering how I got to this particular slide, started off at my website, EfficientMinds.com. Over here it's Seminars, Personal Finance Overview. And if you scroll down a little bit, click on Full Screen, and get rid of the little banner. And we're now on where and how to invest. We started with my investment philosophy, where, long story short, is slow and steady growth for the long term. We looked at the distinctions between investing, being an owner, versus saving, being a loaner. With being an owner, your returns are higher, but there's some risk. With savings, your returns are low, but it's secured by the federal government, but it does not keep up with inflation. So I advocated taking a balanced approach of doing both. I described that approach in Stock, Savings, Real Estate, Other, on how to take a balanced approach to both investing and saving. And now we're going to look at, okay, which companies, brokerage, mutual funds, credit unions, how do we actually implement the investing and saving I talked about in the previous videos and slides. All right, so there's several options as far as accounts where you can purchase stocks and CDs, bonds, all those things. First option is just a brokerage account, discount brokerage account like E-Trade, Charles Schwab, Scottrade. You can choose individual retirement accounts for your retirement funds. Actually, here I say your first 10%. That's not consistent with what I said at the beginning, where I said this presentation focuses on your 10% kind of catch-all money that could be for retirement, it could be for the car you want to buy down the road, could be for the home you're going to purchase. But that still doesn't negate this. You use IRAs for retirement funds, whether or not it's your first 10%. Separate taxable accounts for all the others: car purchase, down payment, kids' college. So in this presentation, I'm describing the 10% for the separate taxable account. You could follow the same advice I'm giving you for Core and Explore and how much to put in stocks versus CDs. All that applies to your retirement account too. So let's see here. Option 2, you could use a brokerage and a credit union. This is the option I'm taking right now. I have a Scottrade account and a credit union account here, Safe Credit Union. Down the road, I'm going to stick with the credit union. I don't like big banks, but I do all my checking and bill payment with my credit union. But I'm going to move all my assets to, in particular, Vanguard, so that I can buy and sell Vanguard mutual funds without commissions. Fourth option is to buy stock directly from companies. There's a direct stock purchase plan, dividend reinvestment plans. You can check out loyal3.com. I don't do any of these. I just do I told you, option 2. You can buy CDs directly from banks, treasuries directly from the federal government. You can buy mutual funds directly as well, which is in essence what I'll be doing down the road here with option 3. There was another point I wanted to make here. I buy CDs from my credit union because the credit union in turn tend to give higher rates on deposit instruments and lower rates when you're borrowing money for, say, cars and homes. So I'm trying, and the money that you loan to the credit union that they eventually loan out is for local businesses. So yeah, you might be able to find a CD on bankrate.com from a bank in New Jersey that pays a 0.01 or 0.2% higher, but you're not supporting your local businesses. But that's your choice. My choice was work with the credit union to help the local businesses out, and still do better than a Bank of America. Okay. All right. So we talked about how to set up an account to implement the Core and Explore approach I talked about in the previous segment. Now, how should you actually launch in? Well, you could launch in, put all your savings in the 75% in the VTI, 25% in some stock pick. You could do that. Or you could do dollar cost averaging. With dollar cost averaging, let's say you had $10,000 and you think the market's high now, but you don't know if it's going to go up or down. You could phase in your investment by putting $1,000 in, easing your way in, putting $1,000 in each month over the next 10 months. So what does that do for you? Well, by investing a fixed dollar amount each month, you'll be buying more shares when the price is low and fewer shares when the price is high. Here's a even more simplified example on this slide. Got $100 a month. Here I say stock price, but let's just say this is an index fund. All right, so currently it's $10. Your $100 will get you 10 shares. Portfolios, $100. Month 2, that's a pretty dramatic drop, but I just want to illustrate a point here at the end. Your index fund dropped from 10 to 4. You took the emotion out of the equation. You're still doing your systematic $100 a month investment, so you buy 25 shares now. Last month you could only buy 10 because they were $10. This month you buy 25. Now your portfolio value is $140. Month 3, stock or index rises to $8. So now you can buy 12.5 shares. So at the end of all this, you'll have 12.5, 37.5, 47.5 shares times 380. I'm sorry, 47.5 shares times 8. You got $380. Now pause for a minute. You started with $300 invested. 100 here, 100 here, 100 here. Now you have 380. So you took your emotion out of the equation here. You decided to buy $100 each month. When the price was high, you bought fewer shares. When the price was low, you bought more shares. And in the end, it worked out. I'm trying to remember where I got this quote. Don't worry about taxes. Let your CPA deal with them. I want to say that was Warren Buffett. On the next slide, we're going to look at some alternatives to this 100 minus your age allocation approach. In the earlier, in part 2 of this series, I talked about 100 minus your age as a kind of a rule of thumb. There's a couple other ways to decide how much should I put in stocks, how much should I put in a CD or a savings account. So let's take a look. This is from Schwab. They have some asset allocation plans going from least risky to most risky. If you look at the number of years with losses, it goes up quite a bit here. And if you look at the average annual return, looking at these last 2 approaches, there's really no need to go from moderately aggressive to aggressive because you'll be losing more on the only for 0.1% higher average. You're exposing yourself to some more downside. So which one of these you choose depends on your appetite for risk. Each column here varies by the mix of stocks versus bonds and cash. Clearly in the aggressive, you're 95% stocks and a little bit in cash. Conservative, you have 80% in bonds and cash and only 20% in stocks. So this is another way other than 100% minus your age to decide how much in stocks and how much in fixed income. Now here it says bonds and cash investments. I lumped those together in this presentation and just say CDs. Okay. Summary. So what did we learn with these presentations? May not have been today. You may have spread it out over a week or something. Open an account at discount brokerage or mutual fund company and save 10% of your net paycheck. At least get the ball rolling on systematic savings and investing. Speaking of investing and saving, do both. There's a couple approaches to determine how much to invest, right? How much to put in that mutual fund and how much to loan or save, how much to put in your savings account. You can do 100 minus your age, or you can do risk tolerance-based allocation from previous slides. You could go and find some calculators on the web that would give you a survey of some psychological questions to figure out, how much did you put in stocks and how much did you put in fixed income. I recommend Core and Explore. So after you've determined, like the example of a 30-year-old should have 70% in stocks, of that 70%, put at least 75% in the index fund, and then you can gamble with the rest if you're feeling lucky. Was that Clint Eastwood, feeling lucky, punk? Anyway, you can set up automatic purchases of index funds to implement this dollar cost averaging. I kind of like the hands-on approach too. Either way is fine, but I'm finding I like the feeling of logging into my credit union, sending money over to my brokerage, and then executing the trade. I feel like I'm doing something. It could all be automated, but at least I feel more mindful, more attentive to my flock, if you will. And also, if the income varies, for instance, royalties from book sales varies from month to month, I can put in the precise 10% amount to transfer over to the brokerage account. Also, consider real estate, additional schooling in your own business with real estate. Be very mindful of those 4 criteria for identifying a good time to buy. All right, now here I've got a few slides on some advanced material. I'm going to breeze through them. These really should be covered in a class, but I threw them here at the end for those who want to read a little extra. So it's time or not time to market. Here's a graph. Let's see, when did this... wait a minute, July 26th. Okay, so this was July 26th of 2013. Had you looked at that graph in 2013, you're like, oh, it's too high, it's an all-time high, it's not the right time to buy. If you look at that graph now, let's go look at it now. And let's see if I do GSPC. So let's get a quote for that. Let's get that same graph today. Let's make this further out here, max. Okay, so this is going to be a little bit like your eye doctor with the 1 or 2. Okay, so here we're looking at the summer of last year, and you're wondering, is the market too high? Right? Is it the right time to buy? And the S&P was at 1691. This is just an index. We're not talking about a dollar amount here, but the relative changes of an index fund are the same. So that's last summer, last July, 1691. You could look at this and say, too late, I'll just wait for it to go down. Well, here we are today, it's at 1857, it went up some more. So you would have missed out. This is alludes to the benefit of dollar cost averaging. Here we are, July 2013, you don't know if it's going to go up or down, but if you follow the approach, I'm going to go back here, of a fixed dollar amount periodically, you'll buy fewer shares when it's high and more shares when it's low. Okay. Let's see here. Yeah. All right. As far as advanced stock analysis, on my website I have a presentation on this. Actually, I have a suite of presentations. So let's go to efficientminds.com. I don't have any videos for them yet, but if you go over here to Mosaic of Analysis, there's 4 pretty comprehensive presentations on advanced stock analysis. You can look at those on your own. The gist of it is centered around the Graham Buffett approach. Hope I spelled that right. You want to buy low and sell high. You only buy stocks that meet the 4 criteria. They're going to have low price to book. And you're going to sell high. You're only going to sell when there's a better alternative. I say let's look at Apple as an example. Well, if you go to let's say part 2 here, you will see that I have some examples for Apple and Activision Blizzard. So you can look at those on your own. Those are some advanced stuff. It's best left for a classroom discussion. Rates going up or down. Here we go. We got an equation. This is another slide that's better for classroom instruction, but I throw it in here for those advanced folks who want to look a little deeper. So when rates go up, 2 things happen. The price of the bond or your portfolio goes down. Well, algebraically, rates, this is R, that's your denominator. If your denominator increases, the fraction decreases, therefore your price decreases. The good news is every year or twice a year you're receiving a coupon payment that you have to reinvest at the current rate. So if rates go up, the value of your portfolio is down, but now that interest check you got, that coupon payment you got, you get to reinvest at a higher rate. This speaks to a concept called duration matching, which is another advanced topic that, again, best left for a classroom discussion. Some strategies, again, advanced strategies. Like, we know rates are going to go up. We don't know when and how much. You could do just buy short-term instruments and just as soon as they mature, roll them over into new prevailing market rate. You could establish a ladder where you try to take advantage of rates being higher at longer maturity instruments. But another advanced topic, and duration matching I hinted at earlier. Yield curve and laddering. Yeah, when you're laddering, notice that the rates on a 10-year bond are significantly higher than a 1-year, which is around here somewhere, right? But the rate on a 10-year bond a couple of years from now may be 5 or 6%. So if it's that high, you're too late. You're locked in at the 2.5. So if you have $10,000 and you put 1,000 into 1 year, 1,000 into 2, 1,000 into 3, 1,000 into 4, and so forth, when that 1-year bond matures, you can take that money and buy a 10-year bond, and eventually you'll have a rotation of bonds, of 10-year bonds with 1/10 of your portfolio maturing each year, where you can make a decision to keep the ladder rolling or buy something. Again, that's an advanced topic. I didn't want to get into a lot of detail in this basic presentation. These are just kind of bonus material. Hey, actually, I called it bonus material. I believe that concludes the presentation. I hope you find it useful, informative, and for further information, I encourage you to, on my YouTube channel, if you just go to YouTube, search for Efficient Minds, I encourage you to subscribe to the channel. No need to subscribe, it's me. But I encourage you to subscribe and keep an eye out for new presentations. Thank you very much.